So you have doubt in first and fourth question. Okay. So, an investor living in Class 2 holds 100 shares of stock in Lucas Corporation. Lucas Corporation pre-tax earnings for the current year are 2 per share, and the company has a payout ratio of 100%. The investor's individual tax rate on dividend is 30%. The effective tax rate on your dollar of funds to be paid out as dividend is closest to. The effective tax rate on your dollar of funds to be paid out as dividend is closest to. Okay. The effective tax rate on your dollar of funds to be paid out as dividends. Okay. Class 2 is a country that taxes dividends based on double taxation system. The corporate tax rate on your company profit is 35%. Then Baroda is a country that taxes dividends based on split rate system. Okay, the corporate tax applied to retained earning is 36%. Well, the corporate tax applied to earnings paid out as dividend is 20%. NICTO is a country that taxes dividends based on an imputation tax system. So all three tax systems are included here. The corporate tax rate on earning is 38. Okay. This is split rate system, Lucas. No, not Luca. This is Class 2. Then Barada. And then NICTO. And here they are asking about Class 2 only. No, Class 2 and Luca. Luca is the company name here. Lucas Corporation. Okay. So Class 2 is a country that taxes dividends based on your double taxation system. The corporate tax rate on your company profits is 35%. Corporate tax is 35%. Now,
Okay, so we have
corporate tax is
to take the
35.
corporate tax as 35. I was taking as 36. That is of Banana.
Corporate tax is 35. So 35% minus 1 minus 35% into individual is 30%. Just check now.
So in this we'll add now 35% plus
Yeah, plus. This is plus.
54.5%. It's coming 54.5%.
Is it matching?
Just a second. Yes, sir. Actually, I was taking 36%.
Mhm. Okay, then fourth one.
Yeah.
The bird in hand argument for dividend policy is based on the idea that uh, is constant for any dividend policy. Because of perceived difference in risk, investors value a dollar dividends more higher. This one,
Yes, sir.
see,
Achha. See. Yeah. C is the answer.
hmm?
C is the answer.
See, na?
Yeah.
Yeah. You want me to show that paragraph?
So start reading that.
See.
Okay, sir.
Okay.
Yeah.
Okay, I'll continue now. From here, right?
Yes, sir.
Okay. Stock buybacks. Stable dividend policy. Stable dividend policy as in focuses on a steady dividend payout, even though earnings may be volatile from year to year. So stable, that is stable dividend policy. Irrespective of the earning, they are going to pay a fixed a percentage. Okay, steady dividend payout. Companies that use a stable dividend policy typically look at forecast of their long-term earnings. Okay. This typically means aligning the company's dividend growth rate with the company's long-term earnings growth rate. Stable dividend payout. So dividend, I'm just checking whether it is amount that is stable or percentage. Stable dividend policy. It is the amount. Yeah, they have not mentioned percentage. Stable dividend. Dividend is being paid. Stable dividend amount only. Okay. A stable dividend policy could be gradually moving towards a target dividend payout ratio. Okay. A model of gradual adjustment is called a target payout adjustment model. So what is target payout adjustment model? We'll see this now. Target payout adjustment model. See, if company earnings are expected to increase and the current payout ratio is below the target payout ratio, an investor can estimate future dividends through the following formula. Okay. Current payout ratio is below the target payout ratio. Expected increase in dividends. Expected earning into target payout ratio minus previous dividend into adjustment factor. Adjustment factor is 1 by number of years over which the adjustment in dividends will take place. Okay, so I'll explain this. Let's do this sum. Through sum, I'll explain it. Okay, just go through this sum now.
International.
So last year, Buckeye Inc. had earnings of $3.50 per share and paid a dividend of 0.70. Okay, so earning is 3.5, dividend is 0.70. In the current year, the company expects to earn $4.50 per share. Okay. The company has a 35% target payout. Target means finally they want to reach to this target and plans to bring its dividend up to the target payout ratio over a five-year period. Calculate the expected dividend for the current year using the target payout adjustment model. So initially it was 3.5, now expected is 4.50. So, yeah. Expected, okay. So how to do this one now? See. See. Expected earnings 4.50 into target payout. That means this is what they are supposed to pay into 35%. That is their aim. Okay. How much is this coming to? Just calculate. 4.50 into 35%.
1.57.
So 1.57 they want to pay 35%. That is the target. Now, so ideally that means this year they should pay 1.57. However, they what we are finding is however they were already paying 0.70. So minus 0.70, how much increment is needed? Just calculate this one.
0.7.
So 0.7, 0.7,
Just a
1.57 minus 0.7.
0.87 actually.
0.87 increment is needed. Okay, 0.87 increment is needed. Okay. Yeah. So this is expected. So we have done till here. Expected earnings. Target payout ratio. And then this is previous dividend. Into adjustment factor. Adjustment factor. So, yeah, adjustment factor is 1 by number of years over which the adjustment in dividends will take place. Okay, so this is for 10 years. See this one. By not for 10, sorry. In the next 5 years, they want to bring it to this target. So if in 5 years they want to bring it to this target, that each year it should be, the formula can be done like this. As per the formula, 1 by number of years into 1 by 5 into 1 by 5. So this will become 0.2. This is how they are getting 0.2 over here. So now when you multiply, you will get 0.175. So this year, dividend should be 0.175. Okay. This year's increment. This is not this year's increment, because this is the formula is what expected increase. So this is the increment. So therefore, expected dividend for the current year. So expected dividend for the current year is already 0.70 is being paid plus 0.175 equal to 0.875. Okay. Have you understood this one?
Yes, sir.
I'll just write, do something more to prove all these points. See,
Okay.
finally, they want to reach to what? 35%. The company has a 35% target rate payout
Yeah.
ratio. Okay, so what I'll do is I'll do year by year and then prove it. You have written this one?
No, that's right.
Okay, you just write down this. Here you give the heading as expected increase in dividend. So here it is expected. The formula is expected increase in dividend equal to expected increase in dividend equal to, and then you write down this formula and then write down these steps.
Okay, sir. Sir.
Yeah.
Right.
Okay. See, um, okay. Okay, so the formula is expected earnings. So I'll write down here again expected increase in expected increase in dividend. So expected increase in dividend is equal to expected earnings into target payout ratio okay into adjustment factor. So expected earning is now 4.50 into target is 35% into adjustment factor is 1/5. Okay, so we got 0.175. Okay, and then we added plus 0.70 and we got 0.875. 0.875. Then next year, what will happen? So next year again, imagine it is 4.50. Okay, into 35 percentage. Which we didn't do minus. There is one more thing here. Minus previous dividend that I didn't do. Okay, let me write here only. Expected increase in dividends is equal to expected earnings. You can put yourself to mute.
Yeah.
Into target payout ratio. Okay. Minus previous dividend. Into adjustment factor. So expected earning is 4.50 into target is 35 percentage minus previous dividend is 0.70. Okay. Into adjustment factor is 1/5. So that is equal to 0.175, and then I added this previous one also plus, so this is plus 0.70, that becomes 0.875. Okay, then next is imagine now again 4.50 into 35 percentage minus this will come here 0.875 into, now this is the previous dividend, okay, next year, and then remaining year will be 1/4. Now you calculate all this.
Yeah. It's coming to 0.175.
Yeah, it will come to the same number. Okay, plus your previous dividend was 0.875 now. Okay, is this step fine?
Yeah.
Previous dividend, because this is what you are going to pay. Now you add these two.
1.05.
This will be the new dividend. Then again next year 4.50 into 35 percentage minus previous dividend, now it will be this one 1.05 into 1/3. Just calculate this now.
0.174. Plus 1.05.
Yeah,
It's 1.225.
Hmm.
0.175
Hmm.
plus 1.225
Hmm.
equals
Hmm.
1.40.
Hmm. Calculate.
0.17. It's 1.575.
1.575.
Yeah.
Okay. Now, if you take 4.50 into initial promise was 35 percentage, right? So now you calculate
1.575.
1.575. Okay. And okay, finally they are reaching to that 1.575. Okay. Then minus 0.70 that they are paying now. Okay. That comes to just minus this. So they are reaching to this target. Then minus 0.70 you do
0.875.
0.875. Now this 0.875 okay, into 0.2, that means 1 by 5. When you do, you will get 0.175. Okay, that is what is being paid now here. So basically this is just to prove that finally it is reaching to 1.575, which is what, 35 percentage. Is it okay?
Yes.
No, you want to write down all this?
I have written.
Written already? Okay. This is just for you to practice so that you will get the conviction about this formula. Okay. Consistent dividend payout policy. So here now all these are easy one only. See. This is constant payout ratio. Here is the ratio. Ratio is constant, but the amount will change. Okay. Ratio is constant, but the amount will change. That is constant dividend payout ratio. Okay. The initial one was the amount. Stable dividend. This is the amount. Then these all are self-explanatory only. Here. There is no obligation on the part of the company to complete an announced buyback program. Unlike their European counterparts, American companies do not need shareholders' approval for open market transactions. Okay. So open market transactions are the most flexible approach, allowing a company to buy back its shares in the open market at the most flexible terms. There is no obligation on the company, part of the company, to complete its announced buyback program. So that means even in India, if they say that they are going to buy back, and later on if they don't buy back also, it is fine. So there is no compulsion on them to buy back. Okay, that is the rule. Okay, so compare share repurchase dividend. So it is giving them flexibility. Okay. And they don't need even shareholders approval in America. Then fixed price tender offer. Fixed price means they are saying at a fixed price they are going to buy back. Okay. Just read this one. These are all easy one only.
Sir, can you explain this Dutch action?
Yeah. Dutch action.
Yeah.
Okay. So Dutch action, see, Dutch action is a tender offer. Tender as in that buyback. Okay. In which the company specifies not a single fixed price, but rather a range of price. Dutch auctions identify the minimum clearing price for the desired number of shares that need to be repurchased. Each participating shareholder indicates the price and the number of shares tendered. Bids are accepted based on the lowest. That means, so they are saying minimum I am ready to buy back my shares at the rate of, at the rate of 100. Imagine at the rate of 100 minimum. So it is just what happens in IPO. In IPO, what does the company say? I am ready to issue shares at the rate of, let's say the range they have given 100 to 110. That book building offer. You know about this one?
Yeah, sir. This
Uh,
one is level 2.
Book building offer that your range will be given, and then some people will quote 120, some people will quote 119, some people 118, some people will quote 110, some people will quote 100, and then they will select from here. If all their requirements are over at 120 itself, then all this will be rejected. Similarly, here it will start from the minimum amount at 100. So at 100 they will start if all their requirements, so they will mention uh, in which the company specifies not a single fixed price but a range of price. So they are ready to buy from 100 to 120. Now whoever is saying okay, you take it from 100, at the rate of 100 from me, they will prefer them first. Okay.
Okay. So, sir,
And
what is
identify
benefit of them? Like for they are taking the lemon.
what is the benefit for the company.
Yeah.
Companies benefit is what, see, they have excess of cash with them.
Yeah.
Now they don't want to further reinvest in the business, they don't have any such plan. So what to do with that cash? To pay dividend. Now if you pay dividend, then you will be taxed. Okay, you have to forego some amount because of tax. So what else can be done? Is, imagine you are a big matured company, you cannot keep on growing now further. So what you will do is you will buy back the shares with that money. So you will get some tax benefit over there because you are not giving them as dividends. You are buying back the company. So this way you are saving some tax. That is the first benefit. Second benefit is when you buy back shares, the number of shares in the market will come down. If
Yeah.
number of shares are coming down, what will happen to earning per
ROE
share?
increase.
Return
ROE
on,
will increase.
yeah, correct. And the earning per share also will go up because number of shares are less. No? So this is another way to increase the performance of the company. Okay. See, each participating shareholders indicates the price and the number of shares tendered. Bids are accepted based on the lowest price first. So here lowest price until the desired quantity is filled. So it is just the opposite of IPO. Okay. Yeah. Then.
Just reading the fourth one.
Yeah. Read.
Okay, so just this, what is green mail scenario?
Where is it?
Third line. In fourth point, third line, first word.
Yeah. Right. Repurchase by direct negotiation entails purchasing shares from a major shareholder, often at a premium over market price. This method is often used in a green mail scenario, where a hostile bidder is offered a premium to go away to the detriment of the remaining shareholders. Yeah.
Okay, hostile bidder was like he buy all the company's share major.
Hostile bidder means a hostile bidder is offered. Hostile is in, it's not a friendly takeover. Somebody is forcefully trying to take over the company. Okay, so for him, company will say like, entails purchasing shares from a major shareholder, often at a premium. This method is often used to detriment of the remaining shareholders. Okay. That means basically the one who is trying to take over, what they will do is the company will purchase at a higher price from other shareholders. Purchasing from a major shareholder, this so say for example, there are many shareholders like this. These are all some major shareholders. Now there is some other hostile bidding happening. Hostile bidding as in somebody is forcefully trying to take over. So what the company will do is company will buy this company shares also, so that they have more shares with them, so that these shareholders can be saved.
So can you explain this again?
Yeah. First of all, there is a hostile bidder. Hostile bidder means what? There is one company. He is a very big, hostile, he is a bidder, very big company. So what happens is this company, let's say this is Reliance company, trying to take over this company. Okay, this is Reliance. Reliance is the hostile bidder.
Okay.
And this is trying to take over this company. So, so this company is a target company. Okay, so company target. Then this company thinks that now what do I do? So what this company does is, these are all the shareholders. These are all bigger shareholder. These are all smaller shareholders. So this company approaches little bigger shareholders and says, I'm ready to buy all your companies, all your shares.
Okay.
Why? Because then they will have more shares. If they will have more shares, these minority shareholders will be protected.
Yeah.
Okay, and this person can be avoided.
Okay.
This reliance can be avoided.
Okay, understood.
Okay. See, where your hostile bidder is offered a premium to go away to the detriment of the remaining shareholders. Acha, he will be offered hostile bidder. 1 minute, 1 minute. Entails purchasing shares from a major shareholder, often at a premium. This method is often used in Greenmail, where a hostile bidder is offered a premium to go away. Entails purchasing shares from a major shareholder, often at a premium over market price. This method is often used in a Greenmail scenario where a hostile bidder is offered premium to go away to the detriment of the remaining shareholders. A negotiated purchase can also occur when a company wants to remove a large overhang in the market that is dampening the share price. Surprisingly, many negotiated transactions occur at a discount to market price, indicating that urgent liquidity needs of the seller motivated the transaction. Okay, let me see if I get better explanation. Green mail, na? Green mail scenario. Investor, corporate bidder buying a large chunk of a target company, threatening a last hostile takeover, and then demanding the company buy those shares back at a significant premium to stop the takeover, giving the raider a fast, risk free profit while forcing the company to pay extra to maintain control. It is essentially blackmailing the company's management into a lucrative deal for the investor, popular in the 1980s takeover era. Okay, green mail scenario. Green mail. Have you understood this one? That means
Yeah,
it is
understood.
as good as you are purchasing a company. So here, by this way, what it means is Reliance is, purchasing this target company shares, and then they are threatening that, look, they will take over the company completely, or else you again buy this Reliance company shares only at the higher price.
Okay.
Okay, at the higher price. So the target company is directly again buying from Reliance only at the higher price.
Okay, sir. Understood.
Yeah. Okay. So they are buying from the bidder only at the higher price. Okay. Hmm. Okay. So now go through this one now.
So,
Jet Fund Inc. has 10 million shares outstanding and has just reported net income of $50 million. Because the company has 100 million of excess cash currently, earnings no return. Jet Fund's directors are considering repurchasing 2 million Jet Fund shares at a premium of 25% over the current market price of 40. Calculate and compare the effect of repurchase on earning per share when the repurchase is financed using the existing surplus cash, or financed using new debt borrowed at an after-tax interest rate of 3%. Okay. Jet Fund has 10 million shares outstanding and has just reported net income of 50 million. But the company has 100 million of excess cash currently, earning no return. Jet Fund directors are considering repurchasing 2 million Jet Fund shares at a premium of 25%, okay, for 40. Calculate and compare the effect of repurchase on earning per share when the repurchase is financed using the existing surplus cash, or case 2, finance using borrowed debt, new debt borrowed at an after-tax interest rate of 3%. Okay. So calculate and compare the effect on EPS, earning per share. So earning per share. So if it is finance using the existing surplus cash, so how much is the surplus cash just reported? EPS, no? So the
8 million.
EPS is EPS is net income divided by
Number of shares
number of
outstanding.
shares. Yeah, number of shares. Okay, so here
Number of shares are 10 million.
10 million.
And net income is 50 million.
So 5 earning per share. Because the company has 100 million of excess cash currently, earning no return. Jet Fund's directors are considering repurchasing 2 million Jet Fund shares at a premium of 25% over the current price of 40. So 40 plus 25%, calculate.
50.
So they are ready to buy at 50, at the rate of 50. Okay, so then how many shares will they buy back then?
2
So
million.
they have 2 million. Okay, are considering purchasing 2 million. So into 2 million, so that will become 100 million.
Yeah.
Okay, so 100 million will be gone. This 100 million will be gone. So if this 100
Okay.
million will be gone, further this 100 million will be gone and this 2 million will be gone. So again in future also it is going to earn
50 million.
50, but next time there will be only 8. Just check this one.
6.25. 6.25.
6.25. An increase of 25%. How's 25%? Just take this difference. 1.25 divided by 5 into 100.
25%.
Okay. Okay, next is finance using new debt borrowed at an after-tax interest rate of 3%. So if you borrow money, then what will happen? So if you borrow, also, see, 100 million you have decided to repurchase. So number of shares will automatically, when you repurchase, it will come to 8 only. So second case also it will remain the same only, no? New debt. After tax cost of fund 3%. 3% is the after-tax cost of funds. So your new earnings will be 47. Is this okay? New earnings will be 47, right? You are earning right now 50,
Yeah.
but there is 3% cost of fund. So it will become 47.
Okay.
47 and 47 divided by 8 million.
No, sure. Okay.
You understood or not?
Just a second.
Or should I explain?
Wait.
Mhm.
If they're asking finance using new debt borrowed at an after tax or interest rate of 3%, like they are borrowing that 2 million only, right?
They are going to repurchase 2 million shares, but they require 100 million amount. That 100 million they are going to borrow from the market. So they will not use their existing money. They will borrow. If they are borrowing, they have to pay 3% interest. Okay, after tax interest. So 3% means in future, out of this 50 million that they are going to earn, 3% will go uh, into the interest
Cost
part.
of debt.
Yeah. So remaining will be 47 only.
Okay, sir.
47 and number of shares will be 8. Right now it is, this is what they are. See, right now this is what they are earning. 50 and 10 million. Okay, EPS. So this is 50 is net income. Now, and this is number of shares. So when this is 50, 3% is the after tax cost of debt. So this will become 47 and this will become 8.
Okay, sir. Understood.
Okay. Then note earnings yield before repurchase is equal to EPS by price paid per share. Earnings yield. Okay, so earnings yield formula is earnings yield. Okay. The formula for earnings yield is EPS divided by uh, market value of yield means you can write market value of share per share. Market value of per share, earning per share. Okay. So price paid per share means our market value price. Okay. Instead of market value, let's go with this formula only. Earnings yield is EPS divided by price paid per share. Okay. So earning EPS is 50, earning divided by 50, 10%. Earning yield before repurchase. So this is before repurchase. Now after repurchase, if I calculate, they are not given here. Earning yield before repurchase. Earning yield before repurchase is equal to 10%. When earning yield is greater than after tax cost of debt, EPS will increase due to the repurchase. So basically what it means is your cost of debt is over here 3% only. Okay, so when cost of debt is over here 3% and your earning yield is 10%, then it makes sense to borrow money. It makes sense to borrow money. Why? Because that cost is lower than this earning yield. Okay, see now, have you understood till here?
Yes, sir.
Okay, yeah, read this part. This is important. EPS will increase when the after-tax funding cost is less than the earnings yield. However, the firm will also have a higher leverage and therefore a higher cost of capital. Accordingly, an increase in EPS should not automatically lead to an increase in share price or in shareholder wealth. Should not automatically lead to an increase in share price or shareholders' wealth. EPS will increase when the after-tax funding cost is less than the earnings yield. However, see, basically what they mean is, if imagine the after-tax, okay, assume for a minute, the cost is, something like 15 percentage. This is 15 percentage after tax cost of debt. If this would have been 15 percentage, then this would be 50 minus 15 divided by 10 minus 2. Is it okay?
Yes, sir.
If you are spending 15 rupees on the cost of debt, then you see what is the impact. 35 divided by 8. Just check now.
Yeah, just a second. 4.375.
So now you see your earning per share has come down.
Yeah.
Before it was 5, no? Now it is 4.37.
Mm.
Now it is not making sense.
Yeah.
But over here, EPS, check here how much, 47 by 8.
5.875.
So 5.875 is greater than 5 initial one.
Mm.
So that only they have mentioned here.
If the cost of
If it
debt
is
increases.
if it is exactly 10 percentage, so then it will be 40 by 8. It will remain the same. You're able to understand all these differences.
Yeah. So, sir,
Okay,
can you
this
tell?
earnings yield, whatever be the earnings yield, if that is your cost of debt,
Okay.
okay, then there is no impact in EPS. If your earning, if your cost of debt is lower than the earnings yield here, cost of debt is lower, so your EPS is increasing.
Okay, sir.
Okay, or I'll write down like a statement. If the cost of fund is lower than the earnings yield, okay, if the cost of fund is lower than the earning yield, the EPS will go up after repurchasing. If the cost of fund is higher than the earnings yield, the EPS will go down after repurchasing. if the cost of fund is equal to the earnings yield, the EPS will be equal to EPS. The EPS will be equal to the previous EPS. After repurchasing. Okay. So here, so see, initially it was 50 by 10. Now, when the earnings is lower, cost of fund is lower, so it will be 50 minus 7, not 50 minus 47, 3% cost of funding, 3% cost of fund. So 10 minus 2. So 47 by 8. What was this amount? 47 by 8?
5.85.
So which is greater than 5. Then here, if it is higher than the earnings yield. Earning yield is what? 10%. How do I know 10%? That is
50 by 5 by 10.
Earning yield is mentioned here, 5 by 50. Okay. So here 50 minus, let's say 15%. How much is this?
4.375.
Which is lower than 5. Then here cost of funding is 10%, which is equal to 5. Okay. Why? Because here this is 10% only. No? Here it is 15%. Is it okay? Understood this part?
Yes, sir.
These all are like this one only. Just go through this now. See, after a stock repurchase, number of shares, outstanding shares will decrease, and the book value per share is likely to change as well. Why book value per share is changing? Because we are paying from the retained earnings, right? If the price paid is higher than the pre-repurchase book value per share, the book value per share will decrease, and vice versa. Okay, if the price paid is lower, then the book value per share will increase. Okay. Just go through this question now.
Yes. Done, sir.
Yeah. Okay. Consider two companies, Alpha and Beta, which are both considering the repurchase of $5 million worth of shares. Additional details are given in the following. Okay, Alpha and Beta stock price. Number of shares outstanding 1 million, 1 million. Okay, same stock price, same number of shares, book value is changing. Calculate the impact of repurchase transactions on book value per share. So they both are considering to repurchase 5 million. Okay, so here initially book value per share is, so book value per share, so book value is 15 by 1 per share is equal to 15. 25 divided by 1 equal to 25. This step is okay.
Yes. Yes, sir.
Then so they are planning to repurchase 5 million worth of shares. Okay, 5 million worth of shares means how many shares that we have to see. 5 million worth of shares. So 20 rupees is one share. One share. So 5 million worth of shares will be how many? So it will be 5 million cross multiplied divided by 20. Just calculate this one.
2,50,000.
Yeah, 1 minute, I'll connect the charger here. Yeah, hello.
Yes, sir.
Okay, you can hear, right? Okay. How much you said? 5 million divided by 20?
50,000.
250,000, yeah. So 250,000 shares we are going to repurchase. If we repurchase 250,000 shares, then the remaining number of shares. Remaining number of shares will be initially we had 1 million shares minus 250,000 shares. 750,000. No? Okay. Then, so now buyback, book value after buyback. So initially it was 15 million. We are now buying back for 5 million. So 5 million will go out of the system. So we will be left out with 10 million. So 10 million divided by 750,000 shares is 13.33. Similarly, here 20 million are there. 5 million will go out of the system because we are buying back. Then we are left out with 20 million. 20 million divided by 750,000. Is it okay? 26.67. So now here you see initially book value was 15, now it is 13. Initially book value was 25, now it is 26. This is the point to be noted. So in the first company alpha, it is coming down, and in the second company beta, it has gone up. Okay. Now why that is happening? Because see, alpha's book value per share of 15 was less than 20. Okay. So less than 20. Yeah. So this is the threshold here. So after the buyback, alpha's book value per share decreased to 13.33. Beta's book value per share increased from 25 to 26.67 after the buyback, because the book value per share was greater than 20. See, basically what it means, you have 15 rupees in your hand, and with this 15 rupees, you are trying to buy 20 rupees share. Okay, so what will happen? Net, then your net worth will come down. Here you have 25 rupees. With 25 rupees, you are trying to buy shares. You are buying back 20 rupees one. So net at the end, you will have more cash with you. Okay, so that means for alpha, it is more like an expensive stock you are buying. You have less cash. So if the price paid is higher than the pre-repurchase book value, the book value will decrease, book value per share. Okay, so pre-repurchase book value was, yeah, this point you should note down. If you check peacefully later on, and then if you practice once, it will be very easy actually. Okay. Is it okay? Fine. It's fine.
Just writing this.
Huh.
Done, sir.
There are 5 common rationales for share repurchase. These are the reasons you asked, right? Why they are doing. Okay. Tax advantage, share price support. That means when they are buying back at the higher price, then it will give positive signal. Okay. You want to quickly read all this, you may read. This is an easy one only.
We'll read after the class.
Okay, fine. So you read it later. I'll tell you, I'll just mark whichever I felt like was important. This one here. But you read everything, it's all easy only to understand. Added flexibility. Okay, let's go through this one. See, basically it says impact of share repurchase and cash dividend of equal amount. So you repurchase, when you repurchase, you are giving it to the shareholders, or when you pay as cash dividend to them, both will have equal impact. As far as the investor is concerned, it will have equal impact only. How it will have equal impact? You see this. Spencer Pharmaceuticals has 20 million shares outstanding with a current market value of 50 per share. This company made 100 million in profits for the recent quarter, and since only 70% of these profits will be reinvested back into the company. SBI's board of directors is considering two alternatives for distributing the remaining 30% to shareholders. Pay a cash dividend of 30 million. So either they can um, pay a cash dividend of 30 million by 20 million shares. This is 20 million shares, and considering two alternatives for distributing the remaining 30. 70% of profits will be reinvested. Okay. Remaining 30% means 30 million. Okay. They have made 100 million profit. So remaining 30 million to be given to the shareholders as dividends. So pay 30 million as dividend to 20 million shareholders. So that comes to 1.5 dollar dividends per share. This step, have you understood? Dividend per share.
Yes, sir.
Then repurchase 30 million worth of common stock. Then repurchase, so pay a cash dividend of 30 million. Okay. Repurchase 30 million worth of common stock. Suppose that dividends are received when the shares go ex-dividend. Suppose that dividends are received when the shares go ex-dividend. The stock can be repurchased at the market price of 50 per share, and there are no difference in tax treatment between the two alternatives. How would the wealth of an SPI shareholder be affected by the board's chosen method of distribution? See, Spencer has 20 million shares outstanding with a current market value of 50 per share. SBI has 100 million in profits for the recent quarter. Only 70% of these profits will be reinvested back into the company. SBI's board of directors is considering two alternatives for distributing the remaining 30%. Okay. So one is you pay as cash dividend, or else you repurchase. Till here it is fine. Question is okay.
Yes, sir.
Suppose that dividends are received when the shares go ex-dividend. The stock can be repurchased at the market price of 50 per share. And there are no difference in tax treatment between the two alternatives. How would the wealth of an SBI shareholder, investor point of view, you have to think, be affected by the board's chosen method of distribution? So number one, cash dividend. So when they are getting cash dividend, then what will happen? See, after the shares go ex-dividend, a shareholder of a single share would have 1.50 in cash and a share worth 48.50. How? Because 1.50, how? Here it is. They will pay 1.50 right here. And when it goes ex-dividend, it will be 50 initially. So this, by the share price will go down by the amount of dividend paid. So that will be 48.50 then. Okay, 48.50. So, yeah, so the ex-dividend value of 48.50 can also be calculated as the market value of equity after the distribution. Okay, so we can do directly like this also, or another way is from this entire amount, 30 million is going out divided by number of shares. You will get divided by 20 million shares, you will get 48.50. So total wealth from the ownership of one share is equal to 50 only. Okay, shall I write this answer?
No, sir, understood.
Understood?
Yeah.
Okay. Now suppose share repurchase is happening. Then what will happen? If share repurchase is happening, see with 30 million SBI could repurchase 600,000 shares of common stock. So that means number of shares will come down by 60,000 or 600,000 here. Okay. And the share price after the repurchase is calculated as the market value of equity after the $30 million repurchase divided by the shares outstanding after the repurchase. Okay. So here it will be 20 million into 50 minus 30 million. So this is the total amount minus 30 million. Okay, so here also it is coming to 50 only because this is the total value of the company out of which 30 million goes away. So remaining amount divided by remaining number of shares, it is coming to 50. So total wealth from the ownership of one share is both the sides it will remain the same, that is 50. So this demonstrates that assuming tax treatment of the two alternatives is the same, a share repurchase has the same impact on shareholder wealth. Is it okay?
Yes.
Understood, right? This one.
Yeah. Yes.
This is all a easy one only. See. Then this is also all similar, but here there is some tax difference.
Okay.
See, in the previous example, we assumed that the company used cash to repurchase its stock. What if the company borrows fund to buy back the stock? Okay, if they are borrowing. So again, it comes back to the same one. If the cost of funding is lower, then they will get benefits, otherwise not. Like here, you see, just read this one, see. 30 million wants to borrow 30 million that it will use to repurchase shares. Okay, so they needed 30 million, right? In the previous case, repurchase 30 million worth of common stock. So now imagine they are borrowing. So if they are borrowing, but at what rate? That is important. See, this threshold is the earning yield. Okay, see here, after tax cost of borrowing is 8%. So it is good for them because the threshold is 10%.
Yeah.
They are borrowing at 8%. Then it is good for them. So
Yeah.
planned buyback is 600,000. So total earning is price per share at the time of buyback is 50. Okay. So EPS after earning will benefit them. How it is benefiting? See, total earning minus after tax cost of funds. After tax cost of funds is what? 600,000 shares they are going to buy back. See this one. Into at the rate of 50. That means this is 30 million. 30 million into 8%. This much money will go away from our pocket.
Okay.
Okay.
Yeah.
And then remaining this many shares also will go away. Finally, earning per share is increasing. Why it is increasing? Because it is lower than the earnings yield. See here it is given. Similarly, if this would have been more than the earning yield, so instead of 8, that is what they have given here. If this would have been 15%, then what would have happened? So then what would have happened? See here, you are paying 15% of 30 million. This is 30 million, 600,000 into 50. into 15%. Now you see what is happening here. It is getting reduced. Is it okay?
Yes, sir.
You can read all this. This only they will ask you, this kind of statement. So remember the threshold. If you are borrowing at the rate lower than the earnings yield, EPS will go up. Otherwise, EPS will come down. The next is dividend safety ratio. Okay, we can finish this also. Dividend safety ratio is the metric used to evaluate the probability of dividends continuing at the current rate for a company. Okay, probability of continuing dividends at the current rate. So traditional ratios such as dividend payout ratio, this is the formula for dividend payout ratio, or its inverse, dividend coverage ratio, are typically, this is the formula for dividend coverage ratio, are typically used for this purpose. Okay, higher than normal dividend payout ratio tends to typically indicate a higher probability of a dividend cut. Yeah, this paragraph is important because you are paying higher than the normal one, then high probability that dividend cut will happen. Okay. Then this one, to pay dividend, how much cash do you have? Free cash flow to equity coverage ratio. Okay, so dividend and share repurchase. To do this, how much cash you have? Free cash flow to equity is the cash flow available for distribution to stockholders after working capital and fixed capital needs are accounted for. So free cash flow to equity coverage ratio. Equity coverage ratio means to cover dividend and share repurchase. Like interest coverage ratio is to cover interest from EBIT. This is to cover dividends and repurchase. Okay.
Done, sir.
You should read all this as well. Later on also you may read again. It's all easy one only. See, now this is again easy sum. You just have to apply the formula, nothing else. Okay, dividend payout ratio. So all those ratios are also given here. Dividend payout ratios formula, dividend upon net income, dividend coverage ratios formula, net income upon dividends, then FCFE coverage ratio. So that one only they have asked, all this. So this you can directly see all these numbers are given.
Yeah.
Okay. Discuss the trend. Yeah, I think this you can do on your own. You just try this. Yeah, this you will be able to do. I'm quite sure only. Okay. You try this, you take this as the homework only. Okay. This one, and then try all these things as well. Okay. Fine. We'll stop now here, and the next chapters are even further easier, only theory. At least here, some easy sums were there is no sums only now. It is all about ESG only. Okay. This we'll see next time. Okay.
Thank you, sir.
Okay. Bye.